Welcome, ladies and gentlemen, to the Swiss Resource Capital AG virtual online roadshow. Today we have Osisko Gold Royalties, the fourth largest royalty company and streaming company in the world. And with us here, you see already Sandeep Singh, the CEO. Good morning to Canada. How are you?
Hi, good afternoon, Jochen. I'm good, thanks. How are you?
All fine, thank you very much. Sun is shining, despite they said some snow tomorrow. I can't believe it even, but all good. So I see people already dining in here. That is great. Let's give it another 30 to 60 seconds. I have to do some disclaimer statements. Of course, first of all, I'm a shareholder of the company, and also the company is part of our SRC Special Mining Situation Certificate, which is listed in Germany and in Switzerland on the stock exchanges. Secondly, nobody can see each other, and nobody really can nobody can talk to each other, because we have to fully comply to the data security law in Switzerland, in Europe, but also in Great Britain. So let's give it another 20 seconds. I will bring up the presentation soon here. And we look really forward to a lively presentation. We let Sandeep first present for approximately 25 minutes, and then we love to have a nice Q&A conversation. I'm pretty sure there's a lot to talk about with the board deal, with the new stream they have acquired here. And we look forward to a great presentation of Sandeep. And please make sure that you use the chat function and the Q&A function to pose all your questions, which I will then ask Sandeep afterwards, as you are used to that, and I moderate it a little bit. So let's get started. I will set up the presentation, and I would say, Sandeep, the floor is yours. Enjoy it.
Sure. Thanks so much, Jochen, and good afternoon, I presume, for most everyone. Thanks for taking the time to get caught up with us. Hopefully in the near future we can do this in person, but until then I hope everyone's staying safe. And Jochen, knowing you extremely well, I don't think it'll take you 25 minutes to ask your first question. So feel free to interrupt me as we go if there are questions that make more sense throughout the presentation. I will be making forward-looking statements here, so please be mindful of that. Look, I think first and foremost, I would leave you with, or start you with one kind of major theme, which I truly believe in right now, that it is the right time to be looking at gold. It is the right time to be looking at a royalty company within gold. And it's also the right time to be looking at Osisko Gold Royalties specifically as your royalty holding in your portfolio, or at least one of your significant holdings. And I'll walk you through why that is, obviously, with all biases that come from running a gold-centric royalty company. But I would say in 2021, it was really a lack of interest in gold. There was complete apathy from investors, especially institutional investors. You could hear a pin drop in the gold market, and that kind of flowed into the gold equities, obviously, of course, as well. That's changing. It first started with inflation wasn't real, then it was inflation is transitory, then we can deal with it. Then it was Bitcoin is the answer as digital gold. Well, the truth is none of that turned out to be true, or at least true for very long. And I think that narrative has now gone away. Certainly, we're dealing with inflation in everything. It's broader, it's deeper, it's going to be more ingrained. Certainly, the challenges in Europe of late, are going to just intensify that. When you're dealing with further disruptions to supply chain, you're dealing with wage inflation, food inflation, oil, and everything that has to be transported via, with the use of oil. I think that's going to lead to inflation running longer and hotter. Ultimately, yes, we're going through a cycle where Federal Reserves are increasing rates. They had to, and they will continue to. But ultimately, I don't think they have the room, the ability to raise rates high enough to combat inflation and certainly overcome it. And part of the reason for that is there's just too much and a growing level of debt in the world. A significant portion, last time I checked, it was 300 trillion of global debt. 12% of global GDP goes to service that debt. So there really isn't room without hurting, global economies to take interest rates too much higher. So that all coupled with Unfortunately, every year in memory, the world seems to be getting riskier, not safer. All that to me means that there's still quite a bit of room for gold to improve. And I would say to you, in all our discussions that we have with either institutional investors or retail investors or everybody in between, that seems to be pretty much adopted, which is definitely a change from most of 2021. So that safe haven role that gold has played in people's portfolio, I think will continue to have a very important role going forward. If you buy into that thesis, or you have your own thesis for why gold matters in your portfolio, I think the royalty model is the right way to play it. It's often been, I think it is again. Certainly in 2020, we saw it being, the year of the miner. People were looking with the gold price moving as sharply as it did, and OPEX and CAPEX not having caught up. There was a lot of torque and a lot of leverage in terms of buying mining names. And as a royalty company, when you have a 97% cash margin, you also don't have the highest leverage to gold. That's fair. So we saw mining companies perform the best in 2020. But I think what we're seeing now is the OPEX side and the CAPEX side of their businesses are catching up to them. They always lag, but they always do catch up. So I think we're seeing an erosion of that free cash flow. We don't have the same issues. We don't have capital cost creep because we don't have capital costs, and we don't have OPEX creep because we have very predictable operating costs. We know exactly what an ounce of gold on one of our properties will cost us. It's either zero in the case of a royalty, or it's very little in the case of our streams. So that dynamic, I think, is playing out significantly. If you followed anybody's guidance for this year, I think you've seen on the operating side, OPEX go up and their CAPEX go up. That's not something you have to worry about with us. As well, the scalability and the diversification of our business or royalty businesses in general is exceptional. We have 25, 26 people to run our dual listed TSX and NYSE listed company. We don't need any more people to continue to build on our asset base. We have everybody we need. And we have a significant amount of asset and cash flow diversification. This year, we'll have 20 assets underpinning our production, or our ounces, if you will. So certainly de-risked from that perspective as well. We are as insulated, and I'll get into this later, as insulated as one can be from geopolitical risk, and that's because of where our assets are, predominantly in the safest jurisdictions, but also because our deals are with operators, and if their deal, if their situation in a specific country changes, if there's more taxation or royalties with the government, which is happening in a lot of places, specifically in South America, we don't get the same impact. Yet we do have significant leverage to gold and all the free upside to anything new that's found in our properties, in our land packages. And that's a scenario that's playing out for us across the board, and I think will continue to be in focus this year. So that's why, royalty companies in general, obviously this is true of a lot of other royalty companies as well, but that's why I think this model works in the span of the market that we're in right now. For us, more specifically, why I think it's a good time to be looking at Osisko Gold Royalties. I mean, the business has matured significantly. We have today about a US $2.1 billion market cap. As I mentioned to you, quite a lot of diversification that we've built up over the last 8 years. So 8 years ago, we had 1 producing asset and 5 assets in total. Now we have 20 producing assets this year in a basket of 160 plus. Significant production. Last year, we did 80,000 GEOs. GEOs, obviously, our acronym for gold equivalent ounces. Silver basically turned into gold. So 80,000 ounces last year at a 97% margin. This year, we've guided to 90 to 95,000 GEOs at a 93% margin. So phenomenal business in terms of cash flow creation. We pay a significant dividend yield, which is important to us. It's only ever gone up. We increased our dividend by 10% last year, the week after gold fell by $100 an ounce. So this business at this margin can continue to deliver higher dividends to our investors over time, especially as our ounces continue to grow for the rest of this decade. And for all that, we trade at one of the lowest multiples in the royalty sector, and frankly, lower than some operating companies. That hasn't always been the case. We are working diligently to climb back and get a multiple that this asset base deserves. And I think this year, with more interest in gold and gold equities, that's certainly something that's achievable for us. So again, the right time for gold for a royalty company, and hopefully you'd agree that there's an interesting royalty company being laid out here in front of you to invest in. In terms of Osisko, it all starts with asset quality. This is a senior company, a senior royalty company portfolio. It just happens to be in an intermediate body. If you look at some of these names on this list, if you follow our stories, you'll find some of the better land packages, some of the better mines in good jurisdictions run by phenomenal operating entities. And that starts with Canadian Malartic, because we have the best gold royalty in the entire business. There are streams that are bigger, but that's the most valuable gold royalty. Happens to be in Canada, and it happens to be on the mine that our founding team built. And we are primarily gold and silver focused. You'll notice whether it's on a geo or revenue basis or on an NAV basis or a longer term horizon, we are about 75% gold and the rest of the business is silver. We do have another category that you see here on the right, on the right bar chart. It's quite small for us now in terms of other commodities. And, we do have royalties on copper and zinc and other base metals. They're just not producing right now. So that piece will grow in time. And, we try to keep that moderate in level. We and our peers have all said we can take about 10% of an other category. We just haven't filled ours too much yet. But certainly copper and base metals, LME traded metals fit into that. But generally speaking, we are a gold and silver company. We like both of those precious metals, and that's where our focus is going to continue to be. I made this point earlier. I think it's worth reinforcing from a political risk perspective. I don't think there's anybody in a better situation than us. We are diversified, but we're diversified in the right places. We are generally, we have assets globally, but we are an America-centric and a North America-centric company. 75% of our NAV alone is in Canada. By the time you add the US and the right parts of South America, you get to this kind of mid 90% level, which is phenomenal. So back to that point I was making earlier, in terms of insulation, we're protected because of the countries we're in, where the rule of law exists and our investments are secure, and the rules don't change after the fact. We're also protected because, of our royalty model. And so, for instance, in South America right now, Chile and Peru in particular, you're seeing governments move further left. Their economies are struggling. They're looking for ways to fund themselves, especially in a post-COVID world. And mining is always a bit of a soft target. So fortunately for us, we don't have too much exposure to us. The exposure that we do have, when you think about things like Mantos for us in Chile, is also low cost. So if in fact there is, as we expect, extra taxation in Chile, we do expect it to be moderate, but our operator can deal with it. We're not exposed to any high cost assets that teeter on the brink of profitability. And if the rules change, all of a sudden they don't become viable. So again, I would say we are as protected as one can be. You're never fully immune, but we are as protected as we can be. And I think this has always been, it always has been an important facet of mining. I think going forward, it's only going to be more important as the investable world from a risk perspective and an ESG perspective just continues to unfortunately shrink every day, every year. On that ESG front, I think here as well, we try to lead and not follow. The good news for us is we always rank well, which is important. I think we rank well for the right reasons, but that in and of itself is not a win. More importantly, we think we're doing the right things to continue to offer a safe and sustainable business to shareholders and stakeholders. Anybody that follows our Osisko story knows that you don't get to move a town off the top of a deposit in Quebec, back in the 2000s and build a mine unless you're doing certain things right from an environmental and social perspective. We've taken that same mindset into choosing partners that we affiliate ourselves with in the royalty company. And I think if you look again at our list of counterparties, you'll see that come through over and over again. If we've been lacking anywhere in the past, it's maybe been on the disclosure side in terms of just patting ourselves on the back of some of the things we do from an ESG perspective. And in 2020, we changed that with our inaugural ESG report. That's going to be a mainstay of our company going forward. And we've also done some interesting things like our partnership with Carbon Streaming Corp, to help fund offsetting or projects that offset or avoid carbon emissions into the world and take back carbon credits in a streaming fashion from it. So I think we're leading in this regard, and we will continue to aim to do so. I mentioned it earlier, those partners that we're so proud of being affiliated with, you see them here, a snapshot of them at least on the top left. Some of the best operators in the business, just full stop. And then equally importantly, we're partnered with them on low-cost mines that matter to them. You see on the right-hand side here, 85%, it's a small number, it's a small font, but 85% of our production is in the lowest half of the cost quartile. That's the point I was making earlier. We're protected there as well. And these assets are core to the companies that operate them. The benefit of that is that means they get a significant amount of time, energy, and money spent on them. And we are the biggest recipient of that because we don't have any of the finding or extraction costs for new ounces that are found on our properties. And when you look at the bottom right here, I used to say until we tabulated the 2021 numbers that we had 1 million meters a year drilled on our properties in the last 4 years. Well, in 2021, it was north of 1.4 million meters, which is an astounding number. It's tough to put into perspective, but that's more drilling than Newmont does, the biggest gold company in the world, or Barrick does, or Agnico, which is a very mining, exploration-centric company. That's more drilling than any one of them do in their entire companies on an annual basis. So we get the benefit of that for free, or our shareholders do. And I can tell you that the output of that has been hugely important to us. We're seeing the benefits of it at Canadian Malartic, which is our flagship asset, in a significant way with the underground mine there that I'll talk to you about. But down the list entirely, we're seeing our reserves, our resources grow, our mine lives extend, expansions and new discoveries being brought to bear. So that is pretty significant for us. And that's a piece of upside that we are now benefiting from really for the first time in our history. I mean, when you think of that, I mentioned early on, I think, Osisko has matured. You think back from one producing asset to 25 assets to 160, from our beginnings in 2014, we've always been building a portfolio, and we will always continue to build a portfolio. But as every time we got into an asset, we were paying for some negotiated version of what that asset was at that point in time. And then it's only with the passage of time, which in mining means years, do you get the benefit of this work, playing out for you. And we're now getting that across the board, as I mentioned earlier, and it will continue. Now that it's started, it will continue to snowball, we think, for a very long time. And that's one of the reasons why our peers, the likes of Franco-Nevada, can trade at 2.5 times NAV. There's always something in the portfolio that they paid for, which is getting better, that it's getting longer, that there's a new discovery on. And that's the part of the cycle as a royalty company now that we're in. And as I mentioned, we expect to stay in for quite some time. That leads to kind of the catalyst, I guess, in a very significant way. I would break them down into two kind of buckets, if you will, on the left and right hand side. First and foremost, that point I made earlier, our core mines are first long life, but also getting longer. So that work that's being put into the assets is extending mine lives, it's announcing expansions, all those positive things that we're looking for, all that free upside. So you have a base that not only is stable, but it's actually growing. So the same assets that generated 80,000 GEOs for us last year, essentially that same asset base with a few additions is generating 90 to 95,000 ounces for us this year. So that is steady and growing. Nothing core to us really falls off a cliff anytime soon, either because of mine life running out, or contractually our assets are good forever for a life of mine of the assets, I should say. So that's the base. Within that, Canadian Malartic on the underground, I will talk to you about. The expansion at Mantos, which is ongoing right now, is significant. The ramp up at Eagle has been slower than we'd like, but it is working in the right direction. So all those things are positive catalysts for us on our existing asset base. And to that steady and growing production, on the right-hand side, we're adding some of the most interesting assets in the development space, for the rest of this decade to grow that production in a very significant way. Most of these assets are well-financed, well-backed, moving forward as quickly as they can in mining speak. So we look forward to having the assets in our portfolio that will lead, to significant growth. And importantly, most of these assets we bought and paid for in the last down cycle, when gold was between $1,200 and $1,300 an ounce. We were the most active royalty company at that point in time. The 3 years leading up to 2020, we spent more on growth than Franco or Wheaton did, which is pretty surreal, thinking, realizing that they're companies that are 10 to 12 times our size, and our shareholders are going to benefit from that for quite some time. Here is kind of the graphical representation of what I was just talking to you about. So from 80,000 last year to a guidance of 90 to 95 this year. Worth pointing out that, and I've said this before when we put out our guidance, that Q1 will be kind of the last quarter where our ounces are similar to previous quarters, and then thereafter we'll start to see a lift that will continue for the rest of the year. The reasons for that are pretty straightforward. Victoria, as most of you probably know, a story that you're comfortable with in the Yukon with the Eagle mine. They don't stack ore for the coldest months of the year on that heap leach, so they always have a stronger second half than first half. We have one asset that we've revived in the Renard diamond stream that had been underperforming for us for 2 years. That asset only kicks in Q2 and starts to generate ounces for us as well. And there are other smaller assets that are starting up that will ramp up over the course of the year. So Q1, we expect to be similar to previous quarters. And then in Q2 and beyond, we expect that growth to kick in. That's for 2022. And if you look at our inaugural 5-year outlook that we put out of between 130 to 140,000 GEOs, that is a huge amount of growth for us. I mean, we're looking at a chart that basically implies 10-11% CAGR growth for the next 5 years, again, on assets that we already own. In the bars, we've tried to show you what assets, predominantly what assets contribute to that growth. There are other smaller assets within that. As I mentioned, these are, San Antonio, Caribou, Windfall. Those are in our stable of companies, be it Osisko Development or Osisko Mining. They're well funded, they're well backed, they've got strong technical teams, and they're moving forward. So that is an exceptional amount of growth, frankly, for a company our size and our scale. To say that we can have 10+% CAGR growth for the next 5 years is pretty remarkable. It stands alone in the royalty space. And then on the right-hand side, the optionality of things that we haven't included is significant. Some of that we haven't included because it's legitimately on the other side of 2026, which is fine. It means that these assets will underpin our growth for the rest of this decade. And some of those we just didn't have enough visibility on yet. 5 years is a long time. So we didn't have enough visibility on, how the operator will either finance those assets or when they will put them into their pipeline of growth. So we just felt it was prudent to leave it on the other side. So that's a pretty exceptional story. I'm sure we'll talk about it later on. I don't think anyone else can make this claim from royalty and streaming assets in particular. So we feel like we're in good shape to show growth if we do nothing for the rest of this decade. But obviously we've been busy in terms of adding new assets, and we're going to talk to you about some of those probably pretty imminently, or I guess next. So 2 transactions that we're quite excited about are Tintic, which we partnered with Osisko Development to get a stream on, and then the CSA mine, which we're partnering with the SPAC, and I'll talk to you about next. A lot of the questions I get, Jochen and everyone in the space, is about competition in the royalty sector and competition for assets, frankly, across the spectrum. But specifically in the royalty sector, how do you compete with bigger incumbents, that are obviously very aggressive? We saw some very high prices, low return deals announced over the last 2 years. We have a lot of newer entrants bidding up the smaller space, the more exploration-centric space. So the question I always get is, how do you compete? And the answer for us has always been, well, we don't compete on price alone. We've built out a portfolio through our accelerator business where we've paid cents on the dollar to get royalties and streams. In hindsight, we've made money on the equities that we've invested in them. And we can do things like Tintic, which came to us through our network. Tintic is a mine that's being acquired in Utah by Osisko Development Corp, so run by Sean Rusin and team. We helped fund it through a stream of between 20 and $40 million US dollars to get, on the top end, 5% of ounces from that, which we think once they ramp up can be about 5,000 extra geos for us on an annual basis. This is an exceptionally high grade mine held by two private entities that our team have been looking at for basically a decade. And when they found this new discovery in Utah, they called our team first. And that's why Sean and Osisko Development was able to secure this asset. They've subsequently used that as a catalyst to raise significant money for Osisko Development across their entire asset suite. And this will be the highest grade gold mine potentially in the world. They'll be putting out some of the best drill results in the world. Right now, they're mining at several ounces per ton on a small scale basis, not grams, but ounces. And ultimately, we believe, even on a bigger rate, at a 500 ton per day rate, which is small for mining, that this will still be one of the highest grade gold mines in the world. So the disclosure needs to catch up here. It was privately held, but we're very excited about this. And if this can contribute about 5,000 geos for us for what we think will be a long time, this will be one of the cheapest streaming acquisitions done in recent history. So that's one answer to how do we compete. The other done within our group, the other done externally to us was the CSA stream that we announced about 10 days ago now, where we're buying a silver stream on the CSA mine, also sometimes referred to as the Cobar mine in New South Wales, Australia, run by Glencore. It's being acquired for $1.1 billion US by a SPAC called Metals Acquisition Corp. That SPAC is comprised of people like Mick McMullen, who is the ex-CEO of Stillwater and Detour, Nev Power, who is the ex-CEO for a decade of Fortescue, Bill Beament, who was a founder of Northern Star, the founder of Northern Star, which is about a $10 billion Aussie producer. So the right Australian team to buy this mine in Australia from Glencore and turn it from a non-core asset to Glencore, which is going back to its trading roots in a lot of ways and streamlining its portfolio, to a very core asset for this new team. So we're buying 100% of the silver for US 90 million. We've also contributed, or will contribute, 15 million to their equity financing. So 105 million US for that transaction. We've also have a potential $100 million copper stream that we've negotiated with them, which is non-binding, and we hope that they'll need that funding as well. Ultimately, I think they're going to be able to raise a ton of equity, but we think there's a good chance, a 50-50 chance, that our copper stream gets activated. On the stream side, that's another basically 5,600 geos of silver turned into gold for a very long mine life. This mine has been able to replace reserves and resources every year for the last dozen years. It's been in production since the 60s and has had that track record ever throughout, and is sitting on a very large land package. So this ticked every single one of our boxes. It's production in Australia, which is a phenomenal jurisdiction. We bought it without being involved in a process. So the SPAC was in a process, but we stapled ourselves to them through our relationship with them early on, and we gave them a fair deal, which they took forward. In doing so, we got a better return on this deal than what's being announced by others in the last year, certainly. And we have a lot of upside to extending mine life. It's sitting on a land package that really hasn't been explored by Glencore. And we think this will be a significant asset for us for a long time. In the process of this, we've also gotten a 3-year ROFR on any other streams and royalties that this group might do on any new assets that they bring into the company. And if anyone follows Mick, Bill, and Nev, I think you'll understand that these are big company folks. Certainly, this will be the core asset for some time. But as they look to grow a base metal business, we certainly think that ROFR and our relationship with them, frankly, is going to be valuable. So this was a phenomenal deal for us. As I mentioned, it ticked every single one of our boxes. Doing these deals is kind of the unicorn in this royalty space, where you can help fund an aggressive acquirer that's trying to do something bigger than what they can, on paper afford, and stepping into this deal with them, I think we signed our CA with them in October. So we had almost 5+ months of diligence, access to the full data room, access to their team, access to their lenders' diligence. So the most bearish view, and then obviously more importantly did our own diligence, including site visits. That's pretty phenomenal when you think about what else gets done in the royalty space. I think I've made most of the points on that first slide, but this is the highest grade copper mine in Australia. Running about 4% copper, 15% grams per ton silver through the underground mine. Their cutoff grade at 2.5% copper is higher than anybody's actual mining grade in Australia. This is a phenomenal asset, and we expect it to be a core one for us for some time. And as well, just on this slide, on the top, what you're seeing there is complete reserve and resource replacement for the last 12 years. We could have gone further. We just didn't have all the data from Glencore and previous operators, but it has been running since the 60s. They continue to find 4, 5, 6% copper at the bottom of the mine. They're finding pods or mineralization further up in a shallow setting. And they have a huge land package where Glencore has hit good runs of 4, 5, and 6% copper and never followed up on it because they didn't need to. So the natural progression, as I mentioned earlier, of having this asset go from non-core to Glencore to core to MAC is going to be hugely important for us. I obviously can't talk about Osisko without talking about Canadian Malartic. This is our flagship asset. It's the flagship asset in the royalty business. You'll all be aware that we have a 5% royalty on the open pit, which runs until the end of this decade. And then last year, Agnico and Yamana made the decision to spend $1.3 billion US to build the underground. So the open pit is obviously the beige outline. I don't know if you can see my cursor or not, but the beige outline at the top. And then the underground is currently about 15 million ounces of all these other colors that you see. Okay. Oh, something's going on there, Jochen. Hopefully.
Yeah, I do that.
Oh, okay. That's an interesting diagram you drew. But either way, the underground here has pushed the mine life out till 2039. So our flagship asset is good for 2 decades minimum. It's worth pointing out that is only based on half of the underground resources currently. Agnico and Yamana have been very clear that as they do more infill drilling, as they get underground via shaft and via ramp, they're going to infill drill more of the remainder. So at the very least, our mine life here is extending beyond 2 decades. They've also been very bullish that the extension drilling at East Goldie in the high grade zone is hitting 1.5 kilometers away. They haven't done enough drilling last year to put that into resource category, but with a similar amount of drilling this year as they did last year, about 137,000 meters, we expect those ounces, the resource ounces, to grow next February pretty significantly. And when I mean significantly, the ounces here at Malartic grow in bunches of millions because it's just so continuous and they're doing so much drilling that's their expectation. They've also hit, if that wasn't enough, this offset zone. It's hard to see, but on the bottom left, this other dotted line, they've hit pierce points that are similar to East Goldie 400 meters away. So when you think about this, the infill drilling will add ounces, the extension drilling will add ounces. If you want to start arm waving, finding new zones, we'll find ounces. So ultimately, you end up in a place, and Agnico and Yamana have been saying this themselves, that you stop extending mine life. And you think about putting in a second shaft to ultimately put more ore through this mill. This mill, which is one of the most efficient in Canada and by so the world, runs at 4.5 cent kilowatt hour hydropower, will ultimately only be a third filled when they transition from open pit to underground, based on the current plan. So if they can put in more ore because they have it, and they're not going to be able to fill that mill, but fill it more so that it's running more efficiently, that's all good news. And I think if I had to kind of paint a picture, I suspect this year will be a year of drilling and studies. They'll put that into a new resource next year. And at some point next year, we're talking about an expansion scenario with more ounces coming out of it. So this is all phenomenal news for us. Even as it is today, the asset is tremendous. I think the point I'm trying to make is the catalysts on this asset are not stopping. They're just going to continue to intensify. I will start to wind down here because I've already run, and shockingly, Jochen, you haven't asked me a question, but I'm going to give you an opportunity.
Yeah, not yet, because we are waiting until you are finished. Because
Okay,
I see already lots of questions here.
Okay.
Please also think on the time.
Yeah, I think the last thing I would say to you, and then everything else, hopefully we can deal with in the Q&A. But Malartic on a bad day can justify our enterprise value almost alone, but it's not our only asset. Last year it was 35,000 out of 80,000 geos. It'll be a similar number out of 90 to 95,000 geos. When you think about other significant assets like Mantos, Eagle, Eleanor, CB, overall, the picture I would leave you with, and I would add Island and Lamac to that and others, big land packages, good jurisdictions, assets that are core to their operators. In the case of Mantos, we're seeing a significant expansion getting tied in right now, as well as an acquisition by Capstone. So the only thing that Mantos was lacking was visibility. It is now in a public company who is touting it, paid a lot of money for it, and is touting it extensively. And they haven't even finished this expansion to 7 million tons per annum. And they're already talking about another expansion for a pretty nominal amount of money. So that's great news. Eagle, the ramp up will continue, and we look forward to their Project 250 taking shape, as well as some very interesting drilling now that they've kind of gotten over the hump on the mine, drilling at depth, drilling at Raven, drilling at Lynx. There's a lot of growth for this brand new mine in Canada that's going to take shape this year. I mentioned some of those other deposits, and we can certainly pick on any of them. But as well, from a growth perspective, I made the point earlier, whether it's Caribou, Windfall, the Kirkland Lake camp of Agnico that is now benefiting from the Kirkland Lake gold infrastructure, Back 40, which is an important growth asset for us. There's a lot of good news events taking shape over this year, next year, and into the future for the company. So with that, Jochen, I will open it up to your questions, and hopefully we can have a good chat.
Fantastic, Sandeep. Thank you very much for that great presentation. Happy to be a shareholder, I must say again. Oh, Jesus Christ, there is really a lot. So let me see. Yeah, maybe first of all, a question shortly from my side. With that CSA mine Silverstream, would you say that you maybe in the future concentrate a bit more to Australia, or you focus more to Australia?
It's a case-by-case thing. I mean, that was a phenomenal transaction for us. Partnering with that group in Australia is tremendous. We think of Canada and Australia as synonymous. They're both great jurisdictions, and to be honest, we were kind of light in terms of our Australian footprint. So getting that asset with that team, potentially access to other things they might do in Australia, just a great news story for us overall. So yeah, if we can get more exposure like that, which is pretty tough to get, but more good exposure in Australia, we'll certainly take it.
Then already there are several questions about when do you plan to raise the dividend?
Look, I think it's always something. We don't have a mechanism, a public mechanism at least, that we've disclosed. So it's always at the purview of the board. But I would say to you, it's often discussed. As I said earlier, it's only ever going to go up first and foremost. Last year we increased it. We had to go to the board in the middle of the year. The week after, gold fell $100 an ounce, and the world was falling, and we still pushed through a 10% increase in the dividend. Thereafter, we went out and we bought through our NSIB about 1% of the company in the 2 months that followed. So between the dividend and the NSIB, we gave back 3% of the company to shareholders last year, if you will. So it's always going to be, returning a capital is always going to be important to us, and we'll continue to find the balance between dividend growth, buybacks, and growth in assets. And the one thing I didn't talk about, which I'm remiss, through that CSA transaction, we had a lot of interest from investors. We had use of proceeds because we had just announced between Tintic and CSA between $150 and $250 million US worth of acquisitions. If the copper stream, if that's the delta, if that gets triggered. So we did do a $250 million financing bought deal a week ago. Again, less than that. A week ago. And happy with the shareholder base that came through, our existing shareholder base, and some pretty good new investors. So that was dilution, and so we're always going to find the balance between dividends, buybacks and growth, but it was dilution for the right reasons. We diluted the company about 10-11%, but between the ounces from Tintic, the silver stream, and if we use that excess on the copper stream, we'll be adding about 18,000 GEOs. So, 20% to production on an annual basis for 11% dilution. So pretty accretive in our minds, but never something that we do without carefully thinking it through.
So you would say that because I have also two questions here about that financing. So you took the dilution because you got also interesting shareholders on the one hand, and on the other hand, you made a fantastic deal, which is, as you said, 18,000 GEOs roughly then in the next years. That made sense to say, okay, that is positive dilution by now, but with the profits, we anyhow buy back the shares.
Look, it doesn't mean that we can't get back to the NSIB. I mean, anytime the market gives us an opportunity, and there's always volatility. People get too high with the highs, too low with the lows. Anytime the market gives us an opportunity to buy back cheap stock, we'll take it. We showed that last year, and we're quite happy when we don't like our deal flow. And this is the other thing we've said: when we don't like the pipeline of opportunities, which I didn't like for most of 2020 and 2021, we're going to take a disproportionate amount of our cash flow and return it to shareholders. And then when we do like our growth, like we did with that CSA deal in Tintic, we're going to take advantage of it because we are a growing company. Usually we'll revert to our credit facility for that, but this was a situation where I didn't want to necessarily just pile up more debt on the company and then obviously have an overhang. So we felt it was prudent to take some capital. Again, we had exact use of proceeds for it. On the production side, it'll depend on whether that copper stream comes in or not. If it doesn't, then we have other interesting things. I would say our pipeline right now looks better than it ever has, or we'll pay down some debt. So yeah, not something we do without careful consideration, but I feel like we have the balance sheet going forward to be able to fund our transactions without equity, and feel pretty comfortable about the growth that we added to the company.
Okay, then I have a combined question. One is from London, one is from Munich. Is the current ratio of precious metals to other royalties in your portfolio more or less what you wish to continue? And I would like to add also, what do you prefer more when you could make a new deal, streaming or royalty?
Yeah, so two very good questions. So I think our mix is good. We want to be heavy gold and silver. That's our objective, is to continue to provide increasing precious metal exposure on a per share basis, full stop. That being said, a good royalty or stream, good cash flow from a long life asset in other commodities is welcome. As we have royalties on copper and zinc and a few other LME traded metals. Obviously, we announced that non-binding copper stream as an option. Getting primary exposure to a mine is also good. The byproducts are great, and we're protected, but if you can get kind of primary exposure like we do in a lot of places, that's good too. So that's how we think of our mix, is gold and silver, but then copper, nickel, base metals in moderation, and then our interest level wanes pretty quickly thereafter. We're not trying to get too exotic with other things. But a good asset has room in our portfolio. On the difference between royalties and streams, we like both. We're obviously more royalty centric, and you can see that with our margins at 93% this year and 97% last year. We have a lot more, if you will, free ounces than cheap ounces. And a royalty at the margin can often be better because you can tie them to title in the ground, as opposed to the streams, which are usually just contractual. But, oftentimes the security is a little bit lighter. But if you're involved with good people, good companies, good assets, they can be pretty equivalent. But all things being equal, I think royalties are a little bit better. And obviously we have more royalties than streams. But we like both. Streams can sometimes be larger instruments. It's tough to make a royalty at 90 million US. With a stream where you're paying them some transfer price back, it's a little bit easier to have the size grow. So I think you're not going to see us change our stripes. Jochen, I think, is the answer to the broader answer to that question. the makeup of our company, we really like it. Precious metals with some other exposure, good jurisdictions. Again, if we venture out of there, it's only because we're getting a better return and we're mitigating those risks with partner quality and asset quality. And then, royalties and streams, not trying to take on too much, atypical exposure. We are a royalty and streaming business. We worked really hard in the last 2 years to put ourselves back in the middle of that lane. We like staying within it.
Okay, super. Question also from my side, because you said you don't want to get too exotic with the metals, but you have now also, let's say, or you will enlarge hopefully the copper stream here. So I see like energy metals within the base metal sector, like copper, but also like tin, zinc, lead. So could you imagine that you expand in the future into those metals, or even uranium, which I think is one of the next bull markets?
Yeah, look, I mean, I think we already have, as I mentioned earlier, exposure to copper, zinc, lead. We've got some tin exposure in Cornwall, which is really nice. So we have some of those. They're just not big pieces because they're not producing yet, and they will grow in magnitude when they start producing. The copper we really like. We've always said if we can put something in that other category, copper would be first, nickel sulfides, if and when you can find them. And then, like I said, other LME, basically traded type metals. And then the interest, we'll look at other things from time to time if they're really good value, but the interest is a lot lower. It's got to be really compelling for us to put it in, basically. So I think within that construct, there's a lot of room for us to work. And I think that's what our investors are looking for from us. And certainly within gold and silver in particular, in the Americas, in traditional royalties and streams, we see enough for us to continue to grow this company significantly. I mean, one of the important things for us is we don't need to do $1 billion of deals a year to show growth, or even to stay flat, which some of our larger peers need to do. We have significant organic growth, back to that page, where we can grow if we do nothing. We can grow even faster by doing small to mid-sized transactions like the ones we just announced. Adding that growth, Tintic, CSA to our internal pipeline, it's a significant amount of growth for us. Smaller to mid-sized transactions still move the needle for us. So if we see value, we'll take it. If we don't, we're very happy being disciplined. We've shown it now for quite a while, and we've only acted, frankly, on transactions that made sense. And I think that's obvious. When you look at our deals, we haven't chased low return deals. We haven't taken new exotic political risk. If we've gone a little bit outside of our comfort range politically, it's been with the right partners with the right assets. So I think we're very much committed to remaining who we are at Osisko. That's where our value add is. That's where our relationships and network are. And that's where we see things that other people don't.
Okay, super. Then 2 questions from a Swiss shareholder from Zurich. How do you handle conflicts of interest within the Osisko empire of companies? And what are your plans in regards to your stakes, for example, in OSK, etc., as well as M&A?
Yeah, sorry, I lost you on the end of that sentence, but I think I get the gist of it. So like, yeah, it is, maybe can be called an empire, hopefully a good empire. But look, we see a lot of value in the things that we're doing across the board. I mean, the way that empire was built was with the Osisko Gold Royalties first, seeding a lot of these accelerator businesses, putting a little bit of equity, taking back a royalty early, and letting those companies go with some of our technical talent to go create value for us and for other shareholders. And that's worked more times than it's not. And given how early some of those stories started, it's exceptional how often it has worked. Excuse me. We would have been happy with a 2 out of 5 hit rate, given how early we were getting involved in some of these assets. To be honest, they're all kind of working. Even the ones that haven't worked capital markets wise yet are working technically, and we think they will work from a market perspective and a share price perspective. So, so that was value added. They've all gone and done good things. We've made money on our equity. We've made a lot of money on our royalties and streams. In terms of conflicts of interest, it happens less than you imagine. Obviously, we're running a royalty and streaming business. They're advancing their assets. We're not looking to commingle them maybe as much as they've been commingled in the past. Anytime we do a royalty on an existing operation, we make sure our independent directors get involved. So we try to limit that. I realize that the people from the outside looking in can't always see it. When we do a deal with one of our sister companies, the royalty company shareholders always think we got too good of a deal. The other company always thinks they got the reverse. So I think we try to manage that by putting on our exposure once and then letting the companies hopefully kind of play out from there.
Yeah. As you are investing also, that's also from London, as you are invested with the firm at a project level, do you try to influence ESG factors with the companies on those assets?
We do. I mean, look, ESG is a big focus for us on everything in our diligence upfront. It's a big focus. As you can see from the people we're involved with, we really don't have any bad actors. We have no bad actors, or certainly, and we hope to keep it that way. I'll be honest, there are companies we can have more influence on than others. Agnico and Newmont don't need a sermon from us on how to handle ESG. But certainly within our stable of companies and some of the smaller entities that we end up involved with, we make sure kind of contractually that we have rights from an ESG perspective, audit rights, information rights, and then more subtly from an influence perspective, there are a lot of groups that come work with us because they want our technical endorsement, and thereafter, as we're working with them, not only do we share that technical skill set, but the ESG footprint that comes along with it.
Mm-hmm. Do you see any tax legislations in your various jurisdictions where you should keep an eye on? Because it might impact royalty firms like yours, for example, Chile. I think you spoke already a bit about that. And also one shareholder from Zurich wants to know, you have been involved in Armenia years ago. What happened with that engagement? Have you written it off?
Yeah, good questions. So there could be a longer answer there, but I'll try to give you the first version. Let me know if you need more color. Overall, I mean, I think there's a lot of countries in the world, unfortunately, that are struggling to fund themselves post-COVID. Certainly, Chile and Peru have gone quite left in their recent elections. There's what you say when you're trying to get elected, and then there's what you do when you govern. I think both those jurisdictions are going to remain mining jurisdictions, but is it clear that there's going to be an extra pound of flesh taken? Absolutely. Our biggest exposure is to Chile. We have kind of small exposure to Peru. So I think those are examples we've already talked about. Again, nothing that impacts us, frankly. We do, there is this push about the global minimum tax in the OECD on some of our streaming transactions. We have less, back to what we said earlier, we have less streaming exposure in our portfolio than our peers do. So, I think it's early days. If in fact that does come to fruition, we have the least amount of exposure in the royalty space, given our makeup, or certainly amongst the least in terms of big companies. And we don't think that's meant to kind of capture firms of our size in any event. I think it's meant for kind of global multinational firms, but we'll see how it transpires. But ultimately, our exposure to that is pretty low to begin with. And then in Armenia, that was one of our few examples of exotic risk. Even then, we stepped into it after the mine was already permitted and it was being built. And it goes to show you that in mining, things can always go wrong. And that asset has been written down, not written off, but written down in our financials to quite a small number. But it's one of those, I would say, in the market, it's been written out of our stock completely. But it's one of those assets that we are working hard to kind of reactivate. It was a really good mine at $1,400 gold. It's a company maker at 19. And there's certainly a lot of examples in the world where a new team has gone into a previous bad situation and been able to turn it around. There are entrepreneurs and groups that have made an absolute living out of that. So we think it's worth finishing. It's about 70% done. We took it in to protect it, and our intention is to get paid back on that stream. So that's kind of a light switch that's turned off. If we can turn that on this year, I think that would be a meaningful catalyst in this, in the sense that there's an asset there that can be brought into production relatively quickly by someone who wants to finish the exercise.
Let's talk a bit more in general on your royalty portfolio, meaning Canadian Malartic still stands for 35,000 ounces per year. We saw that in your presentation. Where do you see the average royalty life of mine? Let's call it royalty and stream life out of the mine life of what you have done. Where do you see the average here by today? As we see 2022, you want to do this year 90 to 95,000 GEOs. That's 20% growth to last year, which is great. And 2026, you want to do 140,000 GEOs a year. So if I put that all together, how long can you stand then, for example, a 140,000 GEO per year? Let's call it mine life if you want, with your existing portfolio.
Yeah. So, and I don't know if you want to pull that up, that slide. We don't necessarily need it while I'm talking. But first on the mine life question, again, the good thing for us is our mine lives on our assets are already quite long. We have our own views, but some of the external views that I can point to, broker research, et cetera, we're talking an average or a weighted average mine life that's in the teens to 15 years, kind of on the books today. And then you've got scenarios where, like I said with Malartic, 2 decades. The question is, what is it going to turn it into? Is it going to turn into 3? Is it going to turn into longer? And if you talk about Canadian Malartic, that's true. If you talk about Eagle, it's a brand new mine. They've got growth at depth. They've got growth on satellite deposits. Now that they've built the mine, they're turning their attention to exploration. I think they said this week 20 million of spend on exploration. That's twice the budget they had last year.
Yeah.
CB, Island, Lamac, large land packages. All you've seen from all 3 groups are either expansions already announced or in the works. You've seen reserves and resources grow materially. So even with the expansions, you're seeing mine lives that continue to be long. So I think we've got a good long mine life on our assets. As I said earlier, there's nothing really core that falls off in the near term. That 1.5 million meters that we got drilled on our property last year, the catalysts from that are still coming. Not all that news flow has turned itself into new mine plans, but we think it's going in that direction. So we think we have longevity to our portfolio that's pretty rare in the gold space. And then to your other question about growth, to that we're adding new ounces. We're not stopping at 130 to 140. I mean, I was asking you to pull up that slide.
Good to hear.
You don't need to. First and foremost, that doesn't include the assets we've already announced because they're not closed. So it doesn't include the likes of Tintic. It doesn't include anything from CSA. But if you look at that if you look at that arrow that we had to the right of it, there are significant assets, and 5 years is a long time. We've left some things out of there. Invariably, some of those will be in the second half of the decade because things in mining always take longer. But if you think about, for instance, Hermosa, which is the South 32 asset in Arizona, they put out a significant pre-feasibility this year. They're working on a feed. That's a big chunky asset for us. If you look at Spring Valley, that's multi-million ounces in Nevada in the hands of private equity. Eventually, we believe that comes out of private equity and enters into a intermediate or larger size company pushing it forward. If you look at the Kirkland Lake properties of Agnico, which now benefit from Kirkland Lake infrastructure, I made clear. There's Upper Beaver first and foremost, which Agnico used to say was a mine. They just didn't know when they were going to build it. Now they have the infrastructure at Macassa and potentially in the Holt complex to put that ore through mills that already exist. And that was the only asset that they talked about in terms of operational synergies with the merger. There were corporate synergies, but that's the only operational synergy. So we're looking forward to this year, now that the merger is complete, to see their plan as to how they're going to put that into effect. On a smaller basis, something called Amalgamated Kirkland, was a pod of 700, give or take, 1,000 ounces that Agnico had, which alone was not viable, but it now sits 200 meters away from underground infrastructure at Macassa. You just need to jump into it and go get it. And they've said they're going to do that too. So I think, we have a lot of other positive assets that aren't factored into that outlook, basically, Jochen, is the point. So we're not stopping. We think there's continued growth. Casino is another, 20, 25,000 ounce equivalent swing producer for us, which has had Rio Tinto step in and buy 8% of Western Copper. So the optionality of this portfolio that was built in a downturn by the Osisko team is exceptional. I can't point to exactly when, how, and by whom, but I certainly feel that we have our decade spoken for from a growth perspective. I don't feel a let off in any way in terms of our growth. And to that, we think we'll have an opportunity to add some continued interesting additional growth. So, this level of diversification and cash flow and growth, I think that story put together is and value, given where we're trading now, I think that's a pretty special story.
Absolutely. You have 160 projects by 2030. Just a personal estimate. How many do you think are online?
Yeah, that's impossible. Certainly, I don't want to mislead people. In that 160, there's a lot of lottery tickets that maybe someday someone focuses on, and we don't need all 160 to come into production. But 20 this year. If you look at how many new assets it takes us to get to the 2026 mark, it's probably really only, when you add the smaller ones, we're still talking fewer than 30. If you start adding, the rest, where can we get to with even a fraction of our portfolio? The answer is a pretty good place.
Super. Last question from a shareholder from Munich in Germany. Analysts predict the price of 22 Canadian dollars for the next 12 months. This is significantly higher than the channel of 12 to 18 Canadian dollars during the last 5 years. So what are the 3 key factors besides a higher gold price to achieve this? And what role do the strong cost increases in energies play for Osisko Gold Royalties? I mean, energies, I think, doesn't matter for you.
Yeah, look, I think the question is a good one in terms of how do we, I told you that we're trading cheap. I do believe it. Obviously, every CEO probably says the same thing to you, but there are structural, historical reasons for it. We've been overcoming them. What do we need to get to a much better place? The answer is not a lot. I mean, I think we need the asset base is continuing to give us meaningful catalysts. I mean, Malartic underground for us was a massive change. And I don't think we got the full benefit of it last year because it came into a market where no one cared. There was complete apathy for gold equities. So I think a better backdrop, which we're seeing that we're in right now, helps. I think the catalyst within the asset portfolio that we have will unlock a lot of value. I think the new acquisitions, if we can continue to show deals like Tintic and CSA, which that 1-2 punch is better than anybody else's I've seen in quite some time, that shows our ability to compete in a tough market. And then from us, I think just, what's consistency, in terms of, in 2019, we shocked some people by adding a development asset. We spun it back out into the right place, showing that we want to live in the royalty and streaming space and maintaining that level of discipline. I think that, it takes longer to get out of the penalty box once you're in it. I do feel like we're coming out of that. And we have the asset value that will underpin our growth and our revaluation. So, this portfolio deserves to trade better. We're going to continue to do all the right things until we get it there.
Great. Then really last question, because it just showed up and it came through my mind also. What are you doing with Osisko development? Can you comment shortly on that, please?
Yeah, no, happy to. Hopefully we're at.
Yeah, that's okay. We are already open.
So Osisko Development Corp, I imagine most people know the story, but that was the asset that we owned 100% of in 2020, acquired in late 2019. When I came in January of 2020, the biggest objective was to put that back into the right vehicle. And we always said, we weren't turning into builders at Osisko Royalties, it was a move to put it into the right vehicle and unlock value. And with the creation of Osisko Development Corp, that's what we did. So Sean Rusin is now running Osisko Development Corp. I'm running the royalty company. He's advancing that asset amongst others now, including Tintic. Our ownership level after the Tintic deal and the financings that they announced, and we always said the market was going to have to finance Osisko Development. So obviously we're, as I say that, we put 20 to 40 in the stream, but that's our traditional business. From an equity perspective, the market is financing Osisko Development. And Sean was able to raise almost 250 million Canadian off the back of that. So with that transaction done and those financings complete, our ownership level will drop to 45%. So we went from owning 100% of the asset and having expenditures on it to 88% of the company, 75% of the company, and now pretty soon 45% of the public company. And we're on the way down. What we haven't done yet is taken any money off the table, but that's something that we'll look to do when we can bring other long-term positive shareholders into the company. We want to make that a tremendous success. We think this year is the year for it, with Tintic being the high-grade story that's going to provide the sizzle from an exploration perspective, whilst Caribou goes through the more boring phases of the development trough, which are important in terms of unlocking value, but not as interesting for shareholders. So we think it's a big year for Osisko Development. We look forward to them being well-financed and unlocking value. And if we find other like-minded partners to bring into that story, we'll certainly look to do that as well, and continue to move in the right direction in terms of ownership.
Super. Sandeep, thank you very much. We crashed the hour already. That was fantastic. Thanks for the update and very meaningful insight into your company. I think you guys are doing everything right. I love it. It is really great. The only thing what you have to do is raise the dividend a bit and you make a lot of people happy. That is for sure. So I wish you all the best. Thank you very much. And I have a very good feeling that we talk quite soon.
Yeah, absolutely. Thanks, Jochen. It's always a good chat. And again, it's tough to do this in a one-directional way, but hopefully that was useful to everyone, and hopefully we can do this again in person sometime not too soon.
That would be great. Yeah, thank you very much. Yeah, ladies and gentlemen, thank you very much for participating in our virtual roadshow today. We hope to bring Osisko Gold Royalties soon to you in person. We are already chatting on that because a personal meeting is also fantastic to see each other really in the eyes. But what is, I think, very clear from today's presentation is Osisko Gold Royalties is in a fantastic shape. They are doing extremely well. Okay, some might comment on the 250 million equity raise with the dilution, but to be honest, I see this as positive dilution because in those shaky times, I really do not like to be over debt financed, and that might have been a little bit the case then. So from that side, I see it extremely positive because it is adding immediate lots of cash flow to the company. Also, don't forget 93% margin. This is really outstanding, well diversified, and as said, they are paying a quarterly dividend, which might rise quite soon, hopefully here. So I would suggest you really have a look onto Osisko Gold Royalties shares. All the brokers see the price approximately 50% higher within the next 12 months. I think this is a great orientation or guidance for that. And yeah, if you have any questions, come back to Sandeep or to myself, please. We look forward to meet you in person again soon. And all the best. Stay healthy. Thanks and bye-bye from Switzerland.